Welcome to Forensic and Investigative Accounting. We're going to be talking about litigation support in special situations. More formally, we're going to be talking about antitrust laws and cost behaviors. And if you will recall, cost behaviors was first introduced in managerial accounting and cost accounting. So if you're unfamiliar with some of these terms, you may want to go back and refer to them. So antitrust laws were basically part of the industrial age in the United States, where several businessmen used this tactic to force competitors out of business. So obviously this was not in the best interest of the country. Therefore, we had federal legislation which pretty much prohibited the formation of monopolies, only allowed when it was in the best interest of the public. So nowadays you'll see that utilities are probably one of the most common monopolies that is allowed. So let's discuss the role of the forensic accountant as it relates to these antitrust litigation. So right now, as a forensic accountant, you might have to determine the liability if an antitrust law was violated. And what you're actually trying to do is you're trying to determine whether the defendant has engaged in predatory pricing. So once you can prove that there is a liability, then you're pretty much going to be asked to estimate damages, similar to what we do in the Tallahassee bean counters case, where we're trying to get the economic impact of some of these frauds. So let's define predatory pricing. So predatory pricing is where you actually price the product so low that it's pretty much just to drive competitors out. Normally, you actually price the product below the average variable cost. So if you notice, you have the selling price minus your variable cost. That gives you the contribution margin. So let's assume your variable cost is $4, but if you price the product at $3, you're losing $1. And that's pretty much is evident of predatory pricing, right? You want to make sure that you have a positive contribution margin so it will help you with your fixed costs. So now that we bring up variable costing and fixed costing, we need to define cost behavior, right? This is basically the changes in volume, how they affect the changes in the cost. And we have several types of cost. If you'll recall, fixed costs are a straight line, right? They stay the same no matter what volume, as long as it is within the relevant range. Variable costs actually increase as the volume increases. Mixed costs have a little bit of both, so you might see it in a stepwise fashion. And then you have semi-variable, they're not entirely variable, or semi-fixed, not entirely fixed, but it does have some characteristics of both. So there's assumptions, and I mentioned relevant range earlier, and we're going to define that, and the time assumptions. And then we're going to discuss the various methods that we use to estimate these, like account analysis method, high-low. This is where you take your highest, so you take maybe 10,000 as your highest and 5,000 as your lowest range, and you try to estimate not only the variable but the fixed cost. Regression analysis being one of the more precise ones, and engineering or work measurement methods. So we're going to discuss several of these. So let's define relevant range, because this is pivotal. Basically, your costs behave in a certain way if they are within this relevant range. And this is not your optimal production level, but it is pretty much your standard production level, what you are normally doing. So if you have 2 production lines that run 2 shifts, that would be your standard or your relevant range. Optimal, you might want to run 3 production lines for 3 shifts. Time assumption basically lets us know that as time passes, the environment changes, and with these changes, your costs might change as well. So why do we really want to know all these cost behaviors? Well, first of all, we like, as a managerial accountants, cost volume profit analysis. Remember, this is where you find out about your break-even point. And this is also where you might actually look for target profits. So these are all, remember, managerial, more internal reporting that we use as accountants and to run the business to make sure that we're getting the largest contribution margin and the largest profit. So as forensic accountants, we need to understand this to be sure to estimate the damages properly. Remember that flexible or dynamic budgeting, that's where you change the volume. So you may have budgeted 10,000 units, but you actually produce 12,000 units. You would adjust all the standard costs for that amount for the 12,000 units. Also remember that we have direct materials, direct labor, and manufacturing overhead. Those are our product costs or our inventoriable costs. And that is pretty much what managerial accounting does, right? We move all of these costs onto the balance sheet as inventory, and then when we sell them, we do expense them through cost of goods sold. Recall that manufacturing overhead, that is also allocated usually by a predetermined overhead rate, where you take the estimated activity for the year and you divide it by the estimated dollars, right? So this would be, up here would be the dollar amounts, and over here would be the activity. So if you have $1 million that you anticipate for manufacturing overhead and you produce 100,000 units, that would get you your predetermined overhead rate. And the reason that all of this is really important to us is because we want to see if predatory pricing happened. And that's, remember, where if you are pricing the product below your variable costs or you're losing money, you're pretty much pricing the product to drive out competitors. Also, you want to make sure that if there is a contractual violation such as predatory pricing, you can prove it. And you can estimate the damages not only in lost sales, profits, but even lost market share. That concludes our lecture for antitrust laws and cost behaviors.